Hello ACCA MOXIE students, my name is Neeraj Sen. Let's do risk management questions. The question is the Mallet company is an Australian firm, okay, currently manufacturing large item of machinery which is due to be exported to the United States. Okay, sale is to be priced in US dollar. Okay, the client is expected to pay. We receive dollar, which is foreign currency. Our country currency is Australian dollar, which is home currency. Okay, and we are an exporter. Okay, this is Mallet company first sale to American, and most of his export normally go Asia. Okay, the client has agreed to pay Mallet company 3 months from now. 3 months from now. 3 months from now, the following relevant additional information is available. Spot rate, and this interest rate is given for foreign currency and home currency. Okay, the interest rate. Okay, and the spot rate is given, so we can calculate the forward rate by using this interest rate parity theory. We can calculate the forward rate. Okay, what will be the Australian dollar receipt to the nearest $1,000 if the transaction had using money market? Okay, so how can we do money market has? Because we are receiving RBCI. Okay, let me elaborate this. When we receive our receipt, then money market has steps: borrow, convert, invest. Okay, so how much we receive? 850,000. Okay, so we need to borrow. This is dollar, so we have to use the dollar interest rate. So which one is the borrowing and investing? Because it is only given one rate, so we will consider this as borrowing rate. Okay, borrowing rate. So 3.3 divide 100 multiplied by, after how many months we receive after actually normally respected to this 3 month. Okay, 3 divided 12 equals how much? 3.3 divided 100 multiplied 3 divided 12, 1.00825. So how much? The answer is $843,045. Okay, we have to convert this into Australian dollar. So we convert this into Australian dollar at spot rate 1.7. Okay, sorry. Spot rate 0.7233 spot rate. Because this is in dollar, so this is the dollar. We have to, dollar rate should be in denominator, and we have to multiply it by 1, or because the answer will be the same, so no need to multiply. Okay, so how much? 1,165,554 Australian dollar. Okay, now we have to invest this using using dollar interest rate. Okay, 2.9 divide 100 multiply 3 divide 12. 2.9 divide 100 multiply 3 divide 12. What? 0.0072. 0.0000725. So how much? Rate will be 1174004. 74004. 400, or I can say 000, right? 000. Okay, right. Because nearest 1000. Which of the following relationship suggests that current long-term interest rate can be used to predict future short-term interest rate? Which of the following suggests that current long-term interest rate can be used to predict short-term interest rate? So okay, so which relationship? Because in expectation theory we expect that in the future, in the long term, we expect in future or in long term our interest rate will reduce. Okay, our interest rate will reduce, so we try to reduce the lenders or so lenders will reduce interest rate now. The short-term interest rate will be reduced. Okay, so this is the expectation theory that defines this. Okay, is not. Okay, what is the forward rate, exchange rate to the nearest decimal? We can calculate this very easily. This is interest rate parity theory. Okay, which says that say we can calculate this. Generally, this method is used by banks to calculate the forward rate. Okay, so we can also calculate forward rate 3 month 7233 multiplied 1.0000. Oh, this one is the how much? This one is the this answer, right? 0.00825, and this one we already calculated this right, 1.00725. This is the dollar, this is US dollar, so this rate should be of the US dollar. So this is this one is the US dollar. Okay, so what is the answer? Answer is 0.7240. Okay, US dollar to Australian dollar. Okay, next, one risk that a company which export and import face is that exchange losses when accounting results in foreign branches or subsidiary converted into home currency. Which risk is this? Group SOFP and branch 1, branch 2, SOFP. Okay, this we have, this is in for example, this is in Australian dollar, the group Australian dollar, but this is in, for example, US dollar or GBP. Okay, so when we convert this into Australian dollar, we face a translation risk. So this is translation risk, right? This is translation risk. Y is a currency option of particular suitable device to reduce exposure to currency movement when tendering to a contract price in contract price in a foreign currency. Y is a currency option in particularly suitable device to reduce exposure to currency movement. Option a particular suitable device. Y option is suitable to reduce movement tendering contract price in foreign currency. Okay, because cheaper. No, it is not cheapest because we have to pay the premium and upfront cost. Least risky. No, it's not least risky because there is not a guarantee of favorable rate. Not a guarantee of favorable rate, right? Least favorable unfavorable effect in published accounts. Least unfavorable effect in published account. No, the effect will be the same. You may not get the contract and therefore the currency. Yes, because if you not get the contract, you lapse it, right? You lapse it. So this is one of the advantage, right? Okay, next is known company, a company based in Centerland. Home currency is CC, home currency, and has been buying components means pay, right? Pay what? Pay FC, foreign currency, right? Pay in foreign currency. One particular payment is this one is the payment made by known company to a supplier in 3 months time. 3 months time. Okay, the spot rate and the 3-month forward rate. Interest rate that can be known as follows. CC, home currency, foreign currency. Okay, currency, foreign currency. What is the cost in central land columns of a forward market hedge? Of a forward market forward cost in central land of forward market, right? Forward, this means forward rate, agreement. What is the cost according to forward rate agreement in 3 months time? Okay, so we have to pay how much? 300,000. We divide it by which rate we have to use because we are paying, so we use when we pay PLR and when we receive RHR. Okay, so lower rate, right? Lower rate, we use lower rate. This one is the lower rate, and this one we will use 6.321. okay, 474608 608 cc. 08 cc. Okay, which of the following relationship attempts to explain difference between forward and spot rate exchange between two currencies and relative rates of interest? Relationship between interest rate, okay, in the countries of origin and two currencies. Interest rate parity explain the relationship between interest between two countries, right? So these are not correct answer. This is the correct answer. What is the cost in centralized using money market hedge? We already done so many questions on this, so you can try this. I mean, it's just very easy. When you pay, you have to invest, convert, borrow. Okay, you invest first. You invest, right? You invest. I can do this now, but you can try You can try this by your own. I mean, I will still do this question, but I think you have to do it. Let me do it very quickly. Okay. So which rate which rate we will use? Invest. Okay. We are in FC. This is FC. We use FC. Fill and frank. We invest, right? We deposit. So we use this rate. 13.5 divide 100 multiply 3 divide 12. How much? 13.5 divide 100 multiply 3 divide 12. How much? 0.03375. Okay, we have to plus 1.03375. Okay, was 2902056. Okay, then we have to convert it at spot rate, and which spot rate we use? We use the lower rate because we are paying, right? Use the lower rate, 6.170. Okay, 290 290 256 470 349. Okay, so 47349. Now we have to borrow at borrowing rate. So we borrow at this, right? 8.1 divided 3 divided 12. How much? 8 divided 5. So now we convert this. Oh, 87484 EC 4 4. Okay, next, indicate by clicking in the relevant boxes whether the following statement on the characteristics of interest rate futures are true or false. Future. Okay, exchange traded instruments are standardized. Okay, amounts and period are standardized. Yes, true. They are legally binding contract. Yes, all exchange traded contract are legally binding contract. They can be bought and sold in secondary market. Yes. They can be used both to hedge risk and speculate. Yes, you can do at stock exchange, right? If the inflation is currently running at 3.1, 3.8 in central land, what is the implied inflation rate in Thailand? Central land, the home, right? So we have already given this portrait. Portrait is 6.3, 6.3321 future spot rate, future spot rate, future spot rate, future spot rate, current spot rate, current spot rate, current spot rate, 6.170. Okay, divide it 1 plus inflation rate. We represent inflation rate in this is FF. This is FF. So this will be the FF. Inflation rate is represented by H, right? Inflation rate is represented by H, and this is the FF, fill and inflation rate. 1 plus inflation of given how much? Already given 3.8, 3.8, 800 multiplied 3 divided 12. 0.8, 0.095. Okay, so 6.321, right? 6.170. Okay, 1 plus plus, okay, 6.321, 6.321 divide 6.1. Two, 4, 0.245. Okay, then we have to multiply it by this 1.0095 all 1 plus 8. Oh, yeah. Why this not working? Okay, now, okay, now actually my pen is not working. Let's do this. How much when we multiply it by 5? 2 minus 1, 0.34 multiplied 100, we convert it into percentage, 3.42%. 3.42%. Okay, each company whose home currency is dollar trades regularly with a customer in a number of different countries. They expect to receive in 6 months or foreign customer current exchange rate in the home currency is spot. We are receiving, so receiving RHR, higher rate, right? Higher rate. We use higher rate. Okay, so in 6 months time, So this is relevant. The interest rate in home country is 4%, as well as considering the use of derivatives to hedge the risk exposure presented by receipt. The treasurer of PZK is looking at internal methods such as invoice in dollar and leading and lagging. These are internal methods, or I told that these are traditional method, or you can say internal methods. It means the same, right? What type of risk exposure is that exposed due to foreign currency receipt? This is transaction risk. This is transaction risk. No, no, no. It is because we will lose, we gain or lose due to transaction. Okay. The next is calculate US dollar loss compared to current dollar value. The period gain curve forward exchange contract. Receipt. Spot, how much we pay? As per spot, we pay, sorry, we will receive this much. At spot, we will receive at spot, we will receive at spot, we will receive we will receive 0.80 by using forward rate agreement. After 6 months, we receive 2606. Now we will receive 285171, but at the forward rate we receive 281 281 281 281 281 650. Okay, so by using forward rate we are receiving less. So by using forward rate we receiving less. So how much is the loss? Loss is the difference is 3521. 3521 is the loss. 521. Okay. Calculate to the nearest annual interest rate in the foreign customer country implied by spot exchange rate and 12-month forward 12-month forward exchange rate. Using interest rate, calculate the forward rate. By using interest rate parity theory, you use and calculate this. We already done so many questions on this, so you have to calculate this. Actually, I will put the numbers. Okay, I will put the numbers. You have to solve this. Okay, so the spot is 4.2080 side 1 plus h. This is the foreign, this is the euro. So we have to calculate the euro, but we have given the home country, not euro. So inflation in euro 1 plus 4%, right? 4 divided 100 multiplied 6 divided 12. 4 divided 100. Okay, we have to calculate for 12 months, for the 12 month. Okay, so we will use this. Okay, sorry, we'll use this forward rate 4.3132, and this is not required here. Okay, because we have to calculate after 12 months 0.04. Okay, you solve this and you pick the answer, correct answer. Okay, next is, if PZK instead chooses to use leading and lagging to manage foreign currency receipt. Okay, which of the following statement PZK should lead or lag is true? Okay, in case of receipt, we can only lead. Because when we receive in the future, we are expecting to receive from a customer after 6 months, or after 12 months. So we can say that we want to receive the amount early, because we have some urgent money requirement, but we cannot delay this amount. Okay, we cannot delay this amount, so lagging is not applicable here. Leading is okay, but when we lag, when we lead, when the foreign currency will depreciate, when the foreign currency depreciate, we try to receive our money in foreign currency as early as possible. We try to receive as early as possible. Okay, so dollar is expected to weaken. Our home country is dollar. Okay, so if our home currency is strengthened, which means reduction in foreign currency, so this is the case when we lead. Okay, this is the case when we lead. This is again the correct answer, so this one is the correct. Okay, indicate by clicking in the relevant boxes whether the following statement is any true or false. Invoice in dollar will eliminate all foreign exchange risk. Invoice in dollar will eliminate all foreign exchange risk that PZK is exposed. Not all, but only sale. If you invoice in only sale, you is still exposed to purchase risk if you are purchasing in foreign currency. So it is false. Invoice in dollar will pass exchange rate risk to customer. If you invoice in home currency, currently the home currency is dollar, so when you invoice in home currency, the exchange rate risk passed to the customer. Yes, this is right. Invoice in dollar may not be commercially acceptable by foreign customers. Yes, if you invoice in your home currency, customers may not accept the may not buy from you. Okay, the next is 258. H company, a large manufacturer, planning to sell existing subsidiary and use funds to buy and build a new factory. Okay, the proceeds of the sale are likely to be delayed, so the directors have estimated that 10 million will be needed. Okay, 10 million needed, so we have to borrow for a period of 6 months. So in 3 months we need, and we will borrow for 6 months, so it means 3 to 9. Okay, 3 to 9 is the contract duration. Given this, the directors have decided that a bank loan would be appropriate as form of finance rather than equity. Okay, after checking the interest rate yield curve in the financial press, the normal yield curve, normal is this. Okay, normal is this. Okay, the treasurer is now looking to hedge the interest rate exposure. Traditionally, each company uses forward rate agreement interest rate exposure, but treasurer is now considering using interest rate future. This is OTC, but now this is exchange traded. They are using exchange traded. Okay, now that the futures will not be as good as, although he or she is concerned that futures will not be as good as FRA. Okay, it might be due to maybe thinking because they cannot has full amount, right? They cannot has full amount, that's why. Okay, so each company bank have offered an FRA. Bank offered an FRA on the following terms: 3 to 1, and we are borrowing, so we will borrow at higher. Bank will give higher rate for the borrowing but lower rate for investing. Okay, which of the following are possible reasons why directors decided that a bank loan are preferable? Bank loan are preferable to equity. Okay, why bank loan are preferable than the equity? The factory will act as a security on the loan. Oh, right now the factory is not right now there is no factory, and they cannot give them as a security, so this is incorrect, because factory will be built in the future. So right now there is no factory. Okay, and they believe theory of gearing with taxation. Oh, because they are preferring bank loan. It might be because interest is tax allowable. Interest is tax allowable, or you get benefit of tax saving on interest, right? According to theory. So I think they have theory in mind, and that's why they are preferring the bank loan. So this is right. All equity sources have higher issue cost than loan. This is not right. Sometimes loans have higher issue cost due to higher interest rate or processing fees, right? So service cost of the debt will be lower. Service cost of the debt will be lower. Yes, this can be right, because investor expect lower return due to lower risk. If investor expecting the lower risk, then they can give the lower rate, right? So this is right. Which of the following would not be a possible explanation for the normal yield curve? Not explanation of normal yield curve. Normal yield curve is like this. Okay, normal yield curve says that expectation theory and liquidity preference theory. Liquidity preference theory, yes, right. And due to expectation theory, the normal yield curve can be the shape, and if the rise in interest rate, so they will try to reduce the interest rate, right? This is also right. This is incorrect. Yes, so this is not explanation. Select from the drop down list is payment or receipt payable due to FRA. Okay, the spot is if the reference interest rate moves to, you see this spot is this, and FRA is 7.8. So FRA is 7.8. FRA spot is 7.6. So 0.2. 0.2 we are paying less interest we are paying less interest, so this is gain for us. So we have to pay. We will pay to bank. We will pay to bank. How much we will pay? We will pay to bank 0.2% multiplied. How much we are receiving? We are receiving 10 million. 10 million. 10 million for 3 months, right? 3 months. $10,000 3 month. Okay, so actually this is 6 month. This is 6 month. We will borrow for 6 month, not 3. Okay. Okay, 0.2% multiplied 6 divided 12. 10 million. 10,000. 10,000. $10,000. $10,000 we have to pay. So this one is the right. D. Which three of the following reasons why futures are not always perfect hedge? Futures is exchange traded. Exchange traded means standard contract. So they have the standard size. Futures have standard size, not coincide with the yes. This is correct. The three reasons. Okay, futures have standardized contract dates. Not coincide when the company wants to take. Yes. The basis risk. Due to basis risk may not coincide because price of underlying asset and price of future may not move with same percentage. Okay, so this is another example. Interest rate risk are hard to predict, so we have to select 3. So already 3 correct. So hard to predict interest rate, this is not right. Which of the following statement concerning forward rate agreement and interest rate futures is or are true? Forward rate agreement. In both cases, company H still needs to borrow money at the market rate. Yes, because in FRA and future, these are separate transaction. These are separate, and actual transaction is separate, right? Actual transaction is separate and these derivatives are separate. So we still have to complete the actual transaction. Okay, both have standardized contract. Yes. Forward rate, no, both do not have standardized contract. Only the futures, because futures is the exchange traded, so this is only the standardized, and forward rate agreement is the OTC, so it is customized contract. So this is incorrect. Both result in net gain or loss to offset against each other. Yes, because if we gain here, we lose here. If we gain here, we lose here. So this is right. 1 and 3. 1 and 3. 1 and 3. Okay. It is now 31st of January. Okay. The treasurer of F company is reviewing cash forecast and funding requirement and identify need for the following transaction. Okay. Transaction 2, F company will have a surplus from 1st of May for 3 months. Surplus for 3 months need to be deposited to earn additional interest. Rather has seen inverted interest rate yield, which means it will the interest will rate will decrease in the future on the deposits. Okay, so the curve of financial advice so is considering using 3 to 6, which means 3 months we are going to invest, and which rate we have to use because we are depositing. So on deposit we will get lower interest rate, but when we go and borrow, bank will charge higher interest rate. Okay, so we will get lower. Okay, interest rate exposure. He is also considering use of interest rate options as an alternative strategy. Okay, F company also needs to borrow long-term debt to finance the expansion. The treasurer would prefer to borrow floating rate. Okay, and but does not feel the company can obtain competitive rates, so thus the considering possibility of swap arrangement. Okay, the advisors have identified that as a possible counterparty. Identify the counterparty. G is the counterparty, and details of the borrowing F and G. F can borrow at 7% and G can borrow at 6%, and G can borrow at lower rate. Okay, and is getting at higher rate. Okay, it is due to the credit history, right? Good credit rating. Okay, so which two predictions are normally associated with inverted yield curve? Expectation theory. Expected to fall in interest rate. Expected to fall in interest rate. Yes, this is right. Expected to fall in interest rate, expected to rise in interest rate, no. In inflation, no. A downturn in the economy, yes. Because if there is a upcoming recession in the economy, then government will reduce the interest rate. During recession, government will reduce the interest rate to 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 stimulate to stimulate the economy. Okay, to stimulate the economy. So this and this one is correct. Okay, which of the following receipt or payment according to FRA? Okay, moves to this is the spot according to FRA and spot. FRA is FRA is FRA is 5, FRA is 5, and spot is 5.5, because we are taking for investment. Okay, for investment FRA is 5, but we are getting higher. How much higher? Higher interest rate, 0.5% higher interest rate we are getting. Okay, so we have to pay this to bank, 0.5% on how much? On 1 million, on 1 million for 3 months, right? For 3 months. So how much is the answer? 1 million 5% divided 12, 1250. 1250 we have to pay. 1250 payment. Okay. Next is the C. Which of the following best describes the interest rate option? Okay. It is the right, not obligation, to buy or sell interest rate. This is correct. An obligation no, it is not an obligation. It is right, not an obligation to obtain a loan or deposit. No, it's not obtain a loan interest rate option. This is interest rate option, loan or deposit at a future date. No, it's actually the option is on the future. Okay, it is on the future though, so this is not right, not a serious to enter into forward rate agreement. No, so this is the correct answer. With reference to interest rate swap, so the following statement is to it allow the company a period of time during which as the option to buy the forward rate agreement. Okay, this is not the option. Swap is not a option. Okay, it lock the company into effective interest rate. No, it is not lock any interest rate. It is the arrangement where parties exchange interest rate. Yes, it involves the exchange of principal. No, 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 no. Only interest rate will be exchanged. Okay, so this is right. Next is indicate by clicking in the relevant boxes whether the following statement concerning the swap are true or false. Whether true or false. Okay. So concerning swap, okay, the company has offered lower interest rate due to better credit rating. G company offered lower interest rate. He has lower interest rate due to better credit rating. Yes, this is true. This is true. Under the swap, loan principals are exchanged. No, only the interest are exchanged. Okay. If G default on the loan taken out, then F would also be liable under the swap. No, F is only liable for the F is only liable for amount he borrowed, right? He himself borrowed, not the not the not not the amount of the G as well. Okay, so this is false. Herd company is based in country whose currency is dollar, expect to receive euro in 6 months time. Foreign customer, the company is concerned that the euro depreciate against dollar, foreign currency will depreciate. Looking to has the receipt. Okay, hard company has an issue of loan note, also has loan note at nominal, which is redeemed in 10 years, and interest is paid at a variable rate interest rate. Central bank base rate. The finance director of hard company believes that interest rate increase in future. Okay, spot rate is, this is spot rate, and interest rate is domestic. This is domestic, and this is home currency dollar, and this is foreign currency euro interest rate. Okay, so 6 month forward rate, 6 month forward exchange rate. What is the 6 month forward exchange rate? So we already done so many questions, so you have to do it by yourself, guys. This question is very easy. So we have to calculate 6 month forward rate. Okay, so just remember, you put this spot rate, this one, and you multiplied it by the euro. Then euro, you have to divide it by 5 divide 100 multiplied 6 divided by 12, and you have to write it 1 plus whatever you get, and then you multiplied it by this and divide by same we have to do here and calculate this. Okay, we already done this type of question before, so I will request you to do this in your homework. Okay, so next is euro. As a euro receipt, what is the primary nature of risk faced by as regard to euro receipt, what is the primary nature of risk faced by hard company? This is a transaction risk. This is the transaction risk we are facing, okay, due to euro receipt, not the exchange rate risk. Okay. Which two of the following hedging method will not be suitable for hedging the euro receipt? For euro receipt, not suitable, okay. For receipt, forward exchange contract, yes. Money market hedge, yes. Currency futures, yes. Forward rate agreement, this is for interest rate risk, right? This is for interest rate risk. Remember, interest rate, generally students get confused between these type of questions because these type of questions test both knowledge from the foreign exchange risk and interest rate risk. So remember, the foreign exchange contract is for the foreign currency risk management, okay, and the agreement is for interest rate risk management, okay. So this is not useful here, okay. Currency swap is for interest rate risk. So these two of the following method is not suitable, okay. Two of the following not suitable, so these are not suitable, okay. Which of the following statements support the finance director belief that euro will depreciate against dollar? Euro will depreciate against dollar. The dollar inflation is higher. If dollar inflation is higher, than euro, then dollar will depreciate, not euro, okay. Dollar will depreciate, not euro. So this is incorrect. Dollar nominal interest rate is less than the euro. So euro interest rate is higher, which means euro will depreciate. So in which case euro will depreciate? This is the question. The second only, okay. So this is the purchasing power parity. This is interest rate parity theory, okay. As regard to interest rate risk faced by hard currency, which two of the following statement is correct, okay. Two of the following statement is correct. In exchange for a premium has interest rate risk by buying the options. Yes, because when we buy the option, we pay the premium, right? We pay premium when we buy the, okay. Buying a floor will give hard company hedge against interest rate increase. No, floor means hedge against reduction in interest rate hedging, okay. So this is incorrect, okay. So hard company has its interest rate risk by selling interest rate futures, now in order to buy them back at a future date, okay. When you borrow, you have to sell, okay, because he wants to borrow. When you borrow, you sell future and then buy future, okay. So this is correct, okay. Taking a variable rate overdraft will allow hard company interest rate matching, okay. No, this is not correct. Why? Because right now we have variable rate loan, okay. Right now we have loan, variable rate loan, okay. Now we have to create loan note which is variable rate. We have to create an asset which is of variable rate. So if the variable rate interest will increase, so asset will increase, and this will will eliminate the risk. Okay, so but here we are taking, so we are double creating our liability, so this is not correct. Instead we have to create a asset at variable rate.
Hey everybody, my name is Neeraj Sen. Thanks for watching. If you are benefited from the lecture, consider like, share and subscribe. If you have any questions, leave them in the comments below. I will meet you in the next video.